The global financial system has been sending subtle signals for months, but something changed recently that has caused a wave of quiet concern among analysts, traders, and institutional investors. Gold and silver markets have just flashed a signal that historically appears before major financial shifts, and yet most everyday investors remain unaware of what is unfolding beneath the surface. At first glance, the recent price movements in precious metals may look like routine volatility. Markets rise and fall every day, headlines come and go, and analysts constantly debate short-term price targets. But when you step back and examine the deeper structural indicators, inventory levels, futures market positioning, physical demand, and central bank behavior, you begin to see a pattern forming that cannot easily be dismissed. This is not just about gold rising or silver falling on any given day. This is about a signal emerging from the core of the precious metals market that historically appears before periods of significant financial stress or massive asset repricing. To understand why this signal matters so much, you have to recognize the role that gold and silver play in the global financial ecosystem. These metals are not simply commodities used in jewelry or electronics. For thousands of years, they have functioned as alternative monetary assets, often gaining attention when confidence in paper currencies begins to weaken. When governments expand money supply aggressively, when debt levels climb beyond sustainable limits, or when geopolitical tensions threaten economic stability, investors often move toward tangible stores of value. Gold is typically seen as the ultimate monetary metal, favored by central banks and large institutional investors. Silver, on the other hand, occupies a unique position because it serves both monetary and industrial roles. It reacts not only to financial stress, but also to shifts in manufacturing, technology demand, and energy transitions. Recently, both metals began moving in ways that caught the attention of professional traders. The signal did not come from a single price spike or crash. Instead, it emerged from a combination of factors happening simultaneously. One of the most important is the divergence between physical metal demand and paper market pricing. In normal market conditions, futures contracts and spot prices tend to reflect underlying supply and demand dynamics fairly closely. However, there are moments in financial history when the paper market, dominated by large financial institutions, moves in a different direction than the physical market, where real metal changes hands. When that divergence becomes extreme, it can indicate that something significant is building beneath the surface. Over the past several weeks, reports from major bullion hubs suggested that physical demand for both gold and silver remains extremely strong. Retail investors, wealth preservation funds, and even central banks continue accumulating metal at a steady pace. In some regions, bullion dealers have reported tightening inventories and increasing premiums for physical bars and coins. At the same time, the futures market has shown sudden waves of selling pressure that pushed prices downward in short bursts. To an outside observer, this might look like a sign that investors are losing interest in precious metals. But experienced traders know that when strong physical demand exists alongside aggressive paper selling, the market may be sending a warning signal. Another part of this signal comes from global macroeconomic conditions. Debt levels around the world have reached historic highs. Governments are balancing massive budget deficits while central banks attempt to control inflation without triggering economic contraction. This balancing act has become increasingly fragile. When interest rates rise, borrowing becomes more expensive for governments, corporations, and households. When rates fall too quickly, inflation risks returning with renewed strength. Financial markets are currently trying to navigate this delicate situation, and precious metals often react strongly during such periods of uncertainty. At the same time, geopolitical tensions have been adding another layer of complexity. Trade disputes, shifting alliances, and regional conflicts have all contributed to a sense that the global economic order is becoming less predictable. When uncertainty rises, capital tends to search for safety. Historically, gold has been one of the primary beneficiaries of that search. But silver, because of its smaller market size and dual demand profile, can experience even more dramatic price movements once momentum begins building. One of the most interesting developments behind the recent shock signal is the behavior of central banks. Over the past several years, central banks around the world have quietly accumulated large amounts of gold. This trend accelerated after periods of financial instability and continues today. Central banks rarely make such moves for short-term speculation. Instead, they typically accumulate assets they believe will help stabilize national reserves during uncertain times. When institutions responsible for managing national currencies begin increasing their gold holdings consistently, it often reflects deeper concerns about the long-term stability of the global monetary system. Silver markets, meanwhile, have been influenced heavily by industrial demand. The global push toward renewable energy technologies has dramatically increased the need for silver in solar panels, electronics, and high-efficiency electrical systems. Every expansion of solar energy infrastructure requires substantial quantities of silver because of its unmatched electrical conductivity. As governments and corporations continue investing in clean energy transitions, the long-term demand outlook for silver remains extremely strong. Yet supply growth has struggled to keep pace, partly because new mining projects require years of development and significant capital investment. When strong industrial demand combines with monetary interest from investors, silver markets can become extremely tight. This is one of the reasons analysts pay close attention to inventory levels in major trading centers. If available stockpiles begin declining while demand remains strong, prices can move rapidly once buyers begin competing for limited supply. The recent shock signal in the market suggests that some of these pressures may already be forming beneath the surface. Another factor contributing to the signal is investor positioning in futures markets. Large institutional traders often take positions based on macroeconomic expectations, currency movements, and interest rate projections. When these institutions shift positions simultaneously, the impact on prices can be dramatic. Recent data shows unusual changes in positioning patterns, indicating that some large players may be preparing for increased volatility in precious metals markets. While it is impossible to know their exact strategies, such movements rarely occur without underlying reasoning tied to broader financial expectations. Currency markets are also playing a significant role in the unfolding situation. The strength or weakness of major currencies, especially the US dollar, has a direct impact on gold and silver prices. When the dollar strengthens, metals often face short-term pressure because they become more expensive for international buyers. However, if investors begin losing confidence in the long-term purchasing power of major currencies, precious metals can quickly regain momentum. The current environment features competing forces: short-term currency fluctuations versus long-term concerns about debt, inflation, and monetary policy. Market psychology adds another layer to the story. Financial markets are driven not only by data, but also by perception. When investors believe that stability will continue, they tend to allocate capital toward riskier assets like stocks or emerging technologies. But when confidence begins to waver, even slightly, capital can shift rapidly toward assets perceived as safer. Precious metals have historically benefited during such transitions. The challenge is that these shifts often happen gradually at first, making them difficult to recognize until momentum becomes obvious. The shock signal emerging in gold and silver markets may represent the early stage of such a transition. Prices may fluctuate in the short term, sometimes sharply, as competing forces push markets in different directions. But the underlying structural indicators, physical demand, supply constraints, institutional positioning, and macroeconomic uncertainty, are aligning in a way that deserves attention. Investors who focus only on daily price movements may miss the broader trend developing beneath the surface. History offers several examples of similar moments. In past decades, precious metals often sent subtle signals before major financial events unfolded. Sometimes those signals appeared months before widespread recognition. By the time headlines began discussing the trend openly, prices had already moved significantly. This does not mean that every signal leads to immediate price explosions, but it does highlight the importance of paying attention to early indicators. For everyday investors, the key takeaway is not panic or blind optimism. Instead, it is awareness. Understanding how gold and silver function within the broader financial system can help investors make more informed decisions during uncertain times. Precious metals should not be viewed simply as speculative assets. They are part of a much larger framework that includes currency stability, industrial development, geopolitical dynamics, and long-term wealth preservation. As the weeks ahead unfold, market participants will be watching several critical indicators. These include central bank policy decisions, inflation data, global energy prices, and inventory reports from major bullion exchanges. Each of these factors has the potential to influence precious metals markets in meaningful ways. If multiple indicators begin reinforcing the same direction, the signal currently appearing in gold and silver could grow much stronger. Another element to watch is investor sentiment. When public attention eventually shifts toward precious metals, price momentum can accelerate rapidly. Markets often move the fastest once a narrative gains widespread recognition. The current stage, however, still appears relatively quiet compared to past cycles. That quiet period is exactly when some of the most important positioning decisions are made by experienced investors. Ultimately, the shock signal emerging from gold and silver markets is not a guarantee of immediate price explosions or dramatic financial collapse. Markets are complex systems influenced by countless variables, but signals like the one appearing now rarely emerge without reason. They reflect shifts in supply, demand, institutional behavior, and macroeconomic expectations that are gradually reshaping the financial landscape. For investors willing to look beyond daily headlines, these signals can provide valuable insight into the direction global markets may be heading. Precious metals have played a role in financial stability for thousands of years, and their relevance has not disappeared in the modern digital economy. In fact, during periods of technological transformation and economic uncertainty, the importance of tangible assets sometimes becomes even more pronounced. As the story continues developing, one thing is becoming increasingly clear. Gold and silver markets are no longer moving quietly in the background. The signal they have just sent suggests that larger forces may be building momentum. Whether those forces lead to a gradual revaluation of precious metals or a sudden surge of investor interest remains to be seen. But the possibility that something significant is beginning to unfold is exactly why analysts around the world are paying close attention. For now, the markets have spoken in the subtle language they often use before major transitions. Gold and silver have sent a shock signal, and while many investors may not yet be ready to recognize it, those who study the deeper indicators know that moments like this are worth watching very carefully. The coming months may reveal whether this signal becomes another quiet footnote in market history or the early warning of a much larger financial shift that few were prepared to see coming.